Hey, what's up, guys? So in the next few minutes, we're going to go through some basic framework of corporate finance. So this is a little bit more academic than we did before, but I think it could be a really good start since I might want to get into more investments and stocks, stuff like that in the future videos. So what do we know about corporations? There are three main types of business organizations: sole proprietorship, partnership, and corporation. The reason why people form corporation is first, limited liabilities, and second, it's really easy to raise capital. And there are two places you can go to raise capital: the stock market and the bond market. In stock market, the expectation of stockholders, the required return is the cost of equity, and in the bond market, the expectation of bondholder, which is the required return of the bond, is the cost of debt. And together, they form the cost of doing business, which is WACC, weighted average cost of capital. In order to get WACC, we need to get the cost of equity and cost of debt. In order to get those numbers, we need to use the dividend growth model or CAPM model for the cost of equity, and we need to get yield to maturity for cost of debt. And let's do it in Excel. So this is a pre-built Excel because I think it would be just easier for me to put in numbers and explain it rather than typing every single words. Say if the price is $20 and next dividend payment is 2.6 and the growth rate is 8%, this dividend would be yearly dividend. And the required return rate would be, here's the formula, that would be dividends, next dividends over price plus growth rate, and that's 21%. Or we can use the CAPM model, which if given data is 1.6, and if the market risk premium is 12.5%. So here, the market risk premium equals the expected market return minus risk-free rate. And risk-free rate, let's assume it's 1%. The cost of equity equals to the risk-free rates plus beta times market risk premium, which is 21%. And for the bond side, if the face value is $1,000 and let's say it sells for $940 and the coupon rate is 10% and it usually compounds semi-annually, then year to maturity 10 years, number of payments would be 2 times 10. And the payment per period, we use the coupon rates over the compounding period and times the face value, and it's $50. Next is periodic yield to maturity, which we can use the Excel formula. Rate and number payment, and make sure the present value, which is the current price, it's supposed to be negative. And then future value is the face value, 0, it's end of the period, and it's 6%. So the yield to maturity, we need to have this times the compounding period, which is 11%. That is also the cost of debt. And next, it's really important to remember that corporation pay tax, so we need to incorporate tax rate into consideration when we calculate WACC. That is, let's assume 35%. So our after-tax cost of debt is cost of debt times 1 minus tax rate, 7.15%. Then let's get to weighted average cost of capital. So equity, let's assume it's 10 million. And debt, let's assume it's 6.5 million. Usually you know the debt to equity ratio, that'd be 0.65, which is pretty normal. And then we need to get the weight of equity in the total capital, and that is 61%, and we'll do the same for the debt. So WACC, that is pretty easy. We just based on this formula on the left side, is weight of equity times the cost of equity plus weight of debt times cost of debt, but that's after tax. And then that is 15.55%. So next is if we have any adjustment factor. This is because sometimes the company has a more risky project or the company is generally more conservative. So we need to take that into consideration as well. If it's riskier, we put plus sign, and if it is less risky, we put minus sign. So let's say that the adjustment factor is 3%. Then the project discount rate is simply use the WACC we calculated plus 3%, which is 18.55. And I built this little table for you guys to calculate net present value and IRR. For IRR, you can use a simple formula from Excel, but for NPV, you need to use the formula down here, which is a little troublesome for some people. So I built up this table, and you can just type in numbers here. Let's try it now. For your initial investment, it always has to be negative. So let's say $20,000. And the first year you get $10,000 in return. And second year on, you get $5,000 each year for another 4 years. Let's say this. So for IRR, it's really simple. You can use the formula IRR. Use this. And you get 17.98%. And next is NPV. In order to calculate that, we need to use WACC, which we got here was 18.55. So NPV is net present value, which we discount all future cash flow back to the present. So now first is the initial investment. Then we need to follow the formula here. The future cash flow for the first year over 1 plus WACC. And this is first year. So this is 1. And we're going to use Command T to log the cell. Then now we can drag it down. So this would be the future value of the second year's cash flow over 1 plus WACC square. And this because this is the second year. And then this is the third year. Then the net present value is simply use sum of all these cash flows plus initial investment, which is negative $337. So this is very important because if the net present value is positive, we accept this project or we invest in this company. If the NPV is negative, then we would reject to invest. We can also do that same with internal rate of return. If the IRR is higher than required return, which is WACC we calculated, then we accept the project or agree to invest in this company. But if the IRR is smaller than WACC, then we reject to invest. If IRR equals discount rate, the NPV must be equals to 0, and therefore it breaks even. So this is very important to note because here, if we do not take into consideration of the adjustment factor, we would actually use 15.55, which would give us a positive net present value. So in this case, we will agree to invest. But if we actually consider the risk factor, then we shouldn't invest. So this is very important to note. And then is the flotation cost. Flotation cost, it simply means the money company needs to pay in order to raise capital from stock or bond market. It is not related to WACC, but it does relate to the weight of both equity and debt. So let's say for equity, in order to raise capital from stock market, let's say it requires 7% of the cost, and for debt, let's assume 4%. Then your flotation cost, which is in percentage format, which is based on true cost, would be flotation cost of equity times the weight plus that of debt times the weight, and that's 5.82%. And let's say that if the project cost was given $6 million, in order to get the true cost of what's given, which must be higher than the given project cost, would be given project over 1 minus the flotation cost, which would be $6.37 million. So this means that the company paid $0.37 million for financial institution and commission to raise those funds. So here's the cheat sheet I did for you guys. If you want to download, feel free to sign up the email list, and I will send you a copy of this Excel. Please leave a comment below if you have any questions. And if you think this video is really helpful, please hit the like button. And if you want to hear more about corporate finance or business analysis, please subscribe. And see you next time.